A good banker should be able to walk you through exactly what metrics they need to see in order for you to start or buy that next office. We rolled out our first product called a PRN loan, which is a small personal loan to help doctors in training or fourth-year students have a little capital to help them with whatever life throws their way.
Somebody coming out of school, or maybe they've been an associate a couple of years, and they're looking at doing either their first acquisition. How far out should they be planning, and what should they be thinking about? Obviously come out of school with a lot of debt. How should they be preparing, and when should they start that?
As far as planning's concerned, number one thing is...
Well, thanks everybody for joining us on Office Hours with Marti Law Group. Super excited to finally have a great colleague and friend, I think I'd say, Brandon Finazzo, who is the head of practice solutions at Panacea Financial. I was practicing how to say Panacea before this just to make sure I nailed it. It has some medical roots, so I didn't want to butcher it, but gotten to know Brandon really well over the past couple of years, doing a number of transactions together and collaborating quite a bit. He's amazing. His team is amazing. And Panacea does some really cool things, kind of this, banking built for doctors by doctors, which truly is unique in the marketplace. Started by Dr. Ned Palmer and Dr. Michael Jerkins, who I've gotten to know, Dr. Palmer at least. I've met him a couple times in Boston, who has a pretty amazing backstory. And the whole brainchild here between them is pretty fascinating. So Brandon, heads practice solutions for the whole company. And so obviously want to give him a minute to introduce himself and add anything I might have missed. But thanks for joining me, man.
Yeah, thanks, Justin. No, I appreciate it. It's been a good time working with you. Always fun. But yeah, like you said, Panacea was founded by a couple of physicians that still practice. Like I said, Dr. Jerkins and Dr. Palmer, and a gentleman named Tyler Stafford, our CEO. So those three gentlemen founded Panacea Financial. And they founded it because when the doctors were in residency, they attempted to get a small loan just to help them, through residency, because, they weren't making very much. And they learned that the big banks didn't want their business at that time. And they asked their, father to co-sign or what have you. And Dr. Palmer and Jerkins said, that's strange. After we finish training, we will, be doing great and could easily, pay a loan. So they sought out to start Panacea to fix that problem. And that is how Panacea started. And we rolled out our first product called a PRN loan, which is a small personal loan to help doctors in training or fourth-year students have a little capital to help them with whatever life throws their way. And that's what spurred it. And after that, we rolled out the commercial group. And that's when I joined, which was in May of 21. And so my background is lending to doctors, dentists, physicians, veterinarians. Worked for Wells Fargo, Citibank, and US Bank for about 12 years prior to this, and had the opportunity to come over and help start the commercial group. And it's been a blessing. We've rolled out some amazing products that work well with today's market. And as the market changes, we change with it quickly. So we're very flat, nimble, and understand what's going on. And our goal is to really make doctors' lives easier. And that's why having two co-founders as practicing physicians, they genuinely care about our customers. And so if something needs to change because the market changes, you bet they're going to make it happen. So yeah, that's myself, a little background on myself and Panacea.
Awesome. I appreciate it. So yeah, it's very interesting because as I've got to know you and know the organization over the past few years, I feel like every time we chat, there's like a new association endorsing you or, the company, right? Or you guys have kind of a broader relationship with various, whether it's dentistry, ortho, general medical groups. So clearly, people are catching on, and I think the docs are realizing the value you bring. So what else is it? A more kind of unique product offering, like in today's space, especially because you've worked at different lenders, right? Even some of the more traditional groups. Like, what are some of the offerings that you guys have that are a little bit unique, and how are you bringing those about?
And it's funny you talk about the associations. Just today, we announced our partnership with the Ohio State Medical Association. So that just took place a few hours ago. So
I can't keep up. Well, congrats.
Yeah, thanks. And so, there's a lot of lending products that doctors have available to them that are fairly common, like buying a practice for 100% financing or starting a practice for 100% financing. But some of the unique ones to Panacea would be a partner buy-in loan that we created, which is essentially a small loan for a doctor to buy a portion of a practice, say 5, 10, 15%, And what's unique about it is typically when you lend to a practice or for a practice, you have to put a lien on the practice. That's how you get your collateral. Well, we understand the market really well and don't need to have that lien on that practice for, certain candidates that qualify. So we have what's called an unsecured partner buy-in loan. It's been very popular, so for some of these DSO owners and the associates buying in, this works really well. Or, if you're in the medical space and you're buying into an ASC, it works really well. So that's a unique product that's done well. Another one is ground up construction. Typically, if you're going to build a building, you'd need an SBA loan. We've been able to create a product where it is done conventionally. And the benefit to that is usually the rates are lower with a conventional loan. The down payment is sometimes less. The fees are a lot less. And typically with SBA, the process can take a lot longer. So it's faster to get done. So those are a couple of unique products that we have, for the marketplace.
And you mentioned kind of where they started there. In residency, can't even get a loan. I mean, was the idea really to say, like, we want to be the one-stop shop, like from school, residency, associateship, obviously in a practice ownership, like we want to be the people who can help you and partner along the way?
Yeah, exactly. So, I mean, you hit the nail on the head, right? If we could help a doctor that's, a fourth year student or in training then, and they can start banking with us. And if they'd like to get into ownership or some sort of ownership, a portion, a partner buy-in, then yeah, we want to be able to kind of help them through their career. If they want to buy and start other practices and grow to 10 offices, 12 offices, we want to be that bank to help them do that. So full suite of treasury management products, so we can handle any of the banking needs that they'll have, and then of course all the lending needs that they'll have, and both on the consumer side and on the commercial side. So consumer side meaning if they needed to buy a house and get a mortgage, right, or maybe they had some student loan debt that they'd like to refi, we can help with that too. So that's exactly the goal, is just to be, a one-stop shop for any financial need, question, even advice. We have partners all around the nation that we trust and will refer to. And if we can help them really well and take care of them, then again, our goal to make doctors' lives easier, it is better for them because they don't have to worry about the financing side. They're taken care of. So that means they can have better patient care. And that's, part of Panacea's overall goal, is just to help overall patient care at the end of the day.
That's awesome. I feel like there's this point where, somebody like outgrows their lender maybe, to some extent, and maybe they have a certain number of practices and there's like needs that, I mean, as we grew, like I had a DSO prior, right? As we grew, we definitely had some headwinds as they were like, listen, you guys have X locations and, partners, and it got really complicated, I think, for like a traditional lender to understand some of that. But you guys, when we were chatting recently, you were telling me about like some of the new products that you offer for, someone who's maybe got their own like emerging DSO, or they're kind of, putting their own together.
Yeah, no, exactly. And I think it all starts with setting the right expectation for the customer, for the doctor and their plans. Each bank to each their own. If they're going to cap at a dollar amount or a number of practices, that's fine. That's that bank's prerogative. I think what needs to take place though is that the doctor customer and the banker have a candid conversation about what's your long-term plans. It's not just, hey, I need this loan, let's get it done, end the conversation. It should be, hey doc, do you plan on growing? If so, how fast and for how long? Are we talking 100 offices? Or are we just talking 10? Do you know? And then that way the banker can walk them through, like, here's how I can help you grow, right? Here's what our guidelines look like to help you with office number 2, 3, 4, and 5. And then how fast can they do that? A good banker should be able to walk you through exactly what metrics they need to see in order for you to start or buy that next office. And so that's what we try to do. We try to, set the tone properly and expectations properly so that the doctor knows who they're partnering with, and so that we do as well. And that way, a year down the road when the doctor wants to buy or start another practice, we're like, whoa, no, way too soon. And then all of a sudden they're like, that's what I needed to do. And what happens is they have a huge prepayment penalty. So if the doctor went to another lender to get help, they have to refinance this, pay a huge penalty. It's a bad position for that doctor to be in. So our goal is to try to avoid that, right? And then that way, if we are not a good fit, that's okay. We're not a perfect fit for everybody. That's why there's so many good lenders out there. But for the ones that want to grow and grow quickly, we've been a pretty good option.
Yeah. Not to date you here, but you've been in the game a while, right? So 2010-ish, I think we talked about, like you kind of really start the healthcare lending journey. I'm older, so, we can establish that. But, what have you seen? It's kind of a wacky climate right now, right? Like with lending and just even deal making, like we're doing M&A daily and deals are just getting a little wacky. I feel like everyone's been a little nervous, understandably so, with, the climate, politically, financially. What do you see as like some headwinds right now, or just differences versus kind of when you started lending,
Yeah,
years ago?
totally. I think one of the biggest things that's been a headwind is cost of construction. That's been going on for a while. I mean, like you said, 2010. I mean, that's too far. But even 6 years ago, the cost of construction in some areas was half of what it is now. And I think what doctors need to realize that is starting a new practice today looked a lot different than it did 6 years ago. So if the construction is double the cost it is now, are associates making double what they were 6 years ago? Right. So it just means it's harder for some to qualify for that, or maybe it's not even qualifying, it's maybe not the best route at all right now. Or if you're expanding, maybe you're just building a smaller office, right? So that the construction can be affordable, because the amount you're going to spend is going to be a lot higher for what you're going to get, right? So if you're going from 4 offices to 8, you may need to make them a little bit smaller, or, something like that. So that's been a huge headwind. Interest rates, they shot up. Treasuries, I don't know, I haven't checked it today, but it's probably in low 4s right now. Typically spread over Treasury is 2.5. And so typically you should see like a 6.5 rate as kind of a normal rate where Treasury is at right now. And so that's historically high. Not too long ago, we were looking at 2.99, 3.5. I don't think that we're going to see that ever again. That would be nice, but rates being higher. So we got higher cost of construction, then it costs more to borrow. Everything is higher. Whoops, a daisy. So I don't know, something to celebrate. That's just what the Mac does. I never know what this computer is going to do. So
A lot of energy. Not a big energy.
That's right. So rates have been a little bit of a headwind. Real estate, I think the prices have gone up. I think right now it's flat. We've seen in the housing market it dip in some states. I think Arizona is taking a pretty large dip right now. Yeah. Still values on real estate. But yeah, so it's just, making sure you're making the right decision, right? We want to coach our customers into the right decision. We don't want to just say you can't qualify because of policy. We want to help them understand, is this a good decision? And then show them via the numbers if it is, right? Or if it's not, and then how to get there, right? So if we decline somebody, we actually want them to agree with us, right? It shouldn't be confrontational. It should be, a lesson, and hopefully they'll fix whatever's going on, or change. Maybe we don't need to start our first practice at 3,000 square feet, right? Maybe we can understand that 2,200 is fine. So yeah, those are a couple of the headwinds.
Knowing that, like if you've got somebody coming out of school, or maybe they've been an associate a couple of years, and they're looking at doing either their first acquisition or first, startup de novo, how far out should they be planning, and what should they be thinking about? Obviously come out of school with a lot of debt, there's different things happening there financially. So like, how should they be preparing, and when should they start that?
Yeah. So if you want to get into ownership and it, even when you're in training, yeah, I absolutely think you should come out of training and get a position as an associate, so you can kind of master that craft before you go and put on the business owner hat, because it is a whole nother job. A lot of people think, oh no, dental practices do great. They have a low default rate. What do I need to know? I'm a doctor. I got it. No big deal. Well, I'll tell you, I've run into countless people who have started a practice and then go, oops, I didn't know I needed to do that or this. So I didn't need to know that at all. So I've always been a big advocate of hiring a consultant, somebody to make sure that you're checking all the boxes, and then how to get patients in the door, because you're going to uncover things you didn't even think you needed to know. So as far as planning is concerned, number one thing is live frugally. Like, make sure you're saving as much as possible. Don't buy a big house. Don't buy a really nice car yet. Maybe, your associate position may be paying you a lot, but if you want to get into ownership and for sure be successful at it, have a massive savings account, if you can. Also, don't rush into it. If you have people or friends that got into ownership, talk to them, ask them, hey, how is the journey starting? What pitfalls did you miss? Like, what mistakes can I look out for that you made? Go talk to people and get as much advice as possible. So saving is a big deal. As far as student loans are concerned, it's all over the place right now, right? It's on pause. It's interest only. It's not on pause. You don't know, but you should prepare for the time that the payment needs to be made, right? In case that happens. You never know what the administration's going to do. So I would just say be prepared for, putting it on a 20-year note at market rates and see what that payment looks like. Could you afford it if that happened, right? You don't want to be blindsided. Student loans aren't a problem to get approved, but they're something that you need to, pay attention to on what that payment could be. And then really paying attention to your production on what type of, in this case, dentistry you want to practice, where you're working as an associate. Ask, other people, what's great production? How can I get there? What things do I need to do? How do I sell dentistry? Like really understand that and get good at it. And so once you're considered a really high producer, it's going to help you that much more when you finally open your practice and you have to focus on things like what your employees are doing, right? Or all the managerial stuff that you may or may not like, but at least dentistry will be easy and taken care of. So just tons of prep. Don't rush, right? Save your money.
It's kind of a horror story. Actually, we had a client who thankfully not with Panacea, but we were helping kind of close on a deal for their first practice. And the guy, strong associate producer, I think 40 days before closing decided to buy himself like whatever high-end, BMW he thought was going to be the greatest to pull up to his new practice. And unfortunately, I'd laugh, but I shouldn't. Unfortunately, kind of killed his deal. So I can't emphasize enough. I'm not a finance guy. My degree is 20 years old, but I tell docs, like, don't do anything crazy. Like, talk to your lender, keep it, even keel until you get through closing. And then, don't do whatever you want, but at least you'll have a little more flexibility once you're probably through underwriting.
That's spot on. It jogged my memory on a pretty funny story. Very similar, but a good one to share. I was in Arizona. I used to cover Arizona. I was meeting with a doctor to talk about starting a practice, and we met at some restaurant, whatever. And we're having the casual conversation on what to do, what not to do. And I'm pretty happy-go-lucky. I like to have fun with my job and joke around and so we're getting through the specifics, and this is a specialist, and he is doing really well, great numbers, great savings. And I'm like, yeah, that's awesome. Just, like I said earlier, you just drive maybe the cheaper car and then rent if you can. And I'm like, just don't go buy like an M5 or something. And, and everything should be good. And so we had a good meeting, wrapped it up. Nothing, when I made that comment, I didn't notice his demeanor change. But sure enough, when we walk out, I walked out left, he went right, and I literally watched him get into an M5. Like, so for some reason, I nailed the type of car, which I thought was funny. He didn't call me ever again because he thought, well, this guy's never gonna. But it was like, oh man. And I'm sure he was able to get a loan. His practice is doing great. But those cars can have a $1,700 payment on them. And that's a lot. Another big one that we've seen a lot that's actually hurt practices is when you get a startup loan and you realize it's not enough for all the equipment you want. Somebody may tell you, maybe the equipment vendor may say, it's okay, get this loan done, and then we'll get you another loan. We'll get you an equipment loan after, and that's fine. You'll be good to go. And doctor's like, oh, sounds great. What they don't realize is the practice loan is on a 15-year AM. Those loans through the equipment company, in this case, are on a 5-year. So your payment's about 3 times the size. And this took place, and then the practice didn't start as fast as possible. And they're like, hey, we're going to need a break on our payment. And I'm like, why? You guys are doing fine. And then they said, well, here's our debt load. And like, your debt load, we know what your debt load is. And they sent us the balance sheet, and there was a $250,000 loan from one of our favorite equipment companies. And it's kind of a no-no, when you work with a practice lender, it's frowned upon. And that's because we care about you, and we don't want you to go have a payment 3 times as the size because you didn't get enough equipment. when banks approve you for a certain amount, they're saying like, that's really all you should get. That's not saying all we want to give you, go ask somebody for more. That's saying in general, based off your profile, this is all you should qualify for. And if that's not enough, then you say, hey, look, that's not enough. I want all this equipment. How come I can't qualify for more? And then walk through why. Like, don't go do this because now this doctor I'm talking about, had been put on a payment plan, is having issues, is leveraged, credit cards are really high, contemplating bankruptcy. You don't want that, right? And that's all because they weren't on the same page, right? So just do yourself a favor, get one loan, and if it's not enough, then say that, and then understand why. But don't go get an equipment loan and think everything's going to be okay a month after you open.
Yeah, it's scary. We see folks, I mean, you probably see it too. They want to spend, I mean, they'll spend more sometimes on a de novo than if, they don't want to pay maybe for a established practice because they think a price is high. And then by the time they're done building out their state-of-the-art, location or what they want to build, it costs more anyway. And you have 0 patients day one. So that's a big issue I've seen.
Yeah, exactly. I mean, look, when you're making those projections to see what the cash flow is going to be, or really see what your cash burn is going to be realistic and understand how are those patients going to get in there. Like, you should be able to explain how we're going to fill, these chairs with patients. And if you can't do a good job of that, then maybe your projections are a little too aggressive. But those days will come, and then you'll realize, oh man, I'm in a tough spot. So, be very realistic with those.
So what's the process? That's a good segue. Like, what does the process look like when somebody wants to, they come to you, they're like, hey, Brandon, I have either a practice I'm looking at or a spot I'm looking at and I want to open. I mean, what's it look like from, application through funding? I mean, the whole story.
Yeah. It's a big process. So if we're talking about a startup, typically you'll go and you'll start looking for a space to lease. I mean, you can buy, but I would only recommend that if you've got a lot of cash and you're getting down some money. But the process I always say is this: if you want to start a practice, okay, start with seeing how much you can qualify for. Us lenders will take a time and walk through and look at your financials and give you an idea of what you can qualify for. Sometimes it's hard to get a full approval until you have some of the other details, like where you're going to open. But I would just see what your FICO score is and see how much you can qualify for with the lender. And then after that, you have a good idea, start to bring in the other parties that are going to help you, right? So you're going to need a big team. Obviously, Justin is part of that team with his legal firm, and you're a real estate agent and your equipment rep and your contractor and maybe a consultant. There's a lot of people that come into play. So as far as a bank's concerned, once you know your spot, you get ideas of what the lease is, you put together good projections, you'll work hard on an awesome business plan, then, apply, send in the paperwork, get that approval in place, and then look to, execute that lease, sign the contract with the contractor and kind of go through that process, get your insurances set up. Those are all your closing conditions. And then it's time to build. Now, there's a lot of things you need to do before that with marketing and credentialing and a lot of that. But I mean, this could be an hour conversation just on this. So we'll kind of just talk through what the bank's doing. So once you get that done with the contractor, you can start your build and make sure sometimes when you're doing the lease that you've got enough time to finish the build, maybe before your payments start. Sometimes these landlords will give you free rent. Ideally, you'd like the construction to be done, and you open your doors before you're making a payment. And that's a good question to talk to your real estate agent and your attorney about is how long those will take. Can we get free rent and kind of budget that in? If it's tough to get free rent, then recognize, hey, I'm going to be building and making a lease payment. How much cash do I have, right? So you got your budget on how much you're approved for, and then you open the doors, everything's done, and a loan will typically have a interest only period for the first maybe year or two, and then you'll be off full P&I. And most of these loans are amortized on 15 years. So that's a very quick answer to what that process looks like. There's a lot to it.
And it's definitely a loaded question because I really tell people, like, build your team, before, get your lender and your attorney. Hopefully, we know the attorney. Get your your CPA, like let's all get together on a call or whatever and just make sure we're on the same page. So there's a strategy here. You again hit on the head with like when we had our DSO, I mean, it was free rent and they were all de novo locations. We had very few acquisitions. So, free rent was huge. A tenant improvement allowance, for folks who aren't familiar. I mean, landlord might contribute money. You're a dental provider, a physician, like you add a lot of value to that real estate. So, you can actually lobby for some money. And of course, like you said, that's where the real estate folks can come in pretty handy. But they're all things that I think people don't realize kind of coming out of the gate that go into it. So building that team early on is so critical. And that's where, the stuff we've done together, I think you guys have been, just instrumental.
Yeah. And one thing, we talk about building the team, make sure they're industry specific. You have an access to a lot of professionals that just focus on even in dentistry, the dental industry. And I'll give you an example. This is a vet example, but we were building a vet hospital, and the veterinarians said, "Hey, we want to use this contractor." They built the building next door. Our friends know them; they're great. I'm like, okay, great. How many vet practices have they built? She's like, well, they haven't built any, but they're awesome. We know them, they're great. And so we actually go through a little process on approving contractors. Again, this is to make sure you're in a good spot. It is extra work with Panacea. Some lenders don't do that, but guess what? It's us looking out for you. So, remember that. And so we looked up this contractor, and they're fine. They just never did any vet hospitals. They're smaller. And so it's a small contractor. They've done a lot of houses, not necessarily commercial. Sure. Residential. And there's other ones you can use. Here's a couple I know, if you mind, give them a call. And she does, and they're 10% more expensive. She's like, look, we're just gonna use this guy if you don't mind. So we make an accommodation because this borrower is really strong. Meaning, if something goes south with this contractor, she's got a lot of cash saved to weather that storm. So 3 months into this, maybe 4, she calls me and goes, hey, I know what you're going to say, but we can't get a hold of the contractor. He's not done. And the project's, halfway, and he's not returning our phone calls. So you can say, I told you so, but we need help to get it fixed. And I'm like, look, I don't want to say I told you so. That's the opposite of what I want to say to you. I said, I'm really sorry to hear that. Let's fix your problem. And so sure enough, she called the contractor we recommended. There was $100,000 kind of fix-it bill that she had to cough up. But then it was done, no problem. She relocated her hospital, and they're doing great. But that happens. That's real. And that was just a leasehold improvement deal. So, if you're doing a ground up, then you really want to make sure you've worked with somebody who's industry specific and has done many, many ground up deals. So good to know the people you work with are industry specific.
Yeah, absolutely. Absolutely. Man, I could pepper you with the questions all day, because I think we run into a lot of the same issues as we're collaborating on deals. But I guess in light of time, you guys, you're out of Austin, but you're national, right? You've got reps kind of across the country who can work with folks. It sounds like any healthcare really vertical, you're able to pretty much accommodate for the most part.
Yeah, that's correct. So all dental specialty, vet specialty, and medical specialists. So all of the above. Mm-hmm.
Awesome. All right. Well, how can folks, track you down? We'll obviously put like a little blurb in the video and all that, but best way to get a hold of you, or
yeah, we could put my email out if you'd like to get a hold of me. Otherwise, if you'd like to inquire on just the products we have or questions, I would just go to panaceafinancial.com. You'll see some drop downs on practice loans, or if you're interested in the consumer side. We're very fast at getting back to people. So you just fill out an inquiry of what product you're looking for. You'll get a response in under 24 hours with the proper representative, because obviously we have people for all different products. But if you'd like to email me and say hi, ask a question, whatever, more than happy.
All right, awesome. And also they can look out probably for their local association, since you guys are partnering with everyone there is at this point. So
you could go to the ADA and look up practice lending, and you'll find us too. So we're the ADA endorsed lender.
Awesome. Cool, man. Well, thank you again for the time. And
I appreciate you.
Yeah, we'll ping you, reach out to me, but hopefully we'll be collaborating on a bunch more stuff. So thanks again.
Sir, thank you.